This is the DC Bar's Brief Encounters podcast. I'm Don Resnikoff, a member of the DC Bar's antitrust and consumer community. I'm also active in an ad hoc group called Crypto Skeptics. Our focus today is on President Trump's August 7 executive order allowing the sale of alternate assets, including crypto assets, to 401k plans and other retirement and pension plans. The executive order directs the Labor Department and the Securities and Exchange Commission to issue guidance allowing employers and plan sponsors to include various private assets in 401k plans. That means employees could have access to investments such as private equity, hedge funds, private credit, real estate investment trusts, and venture capital funds through their 401ks. The order also makes it easier for plan sponsors to include cryptocurrency in 401k plans. This is a major development for investors and increases the chances that investors will be exposed to more risky investments. We're fortunate to have with us today 3 experts in the field who will help explain the president's order. I'm going to introduce them very briefly. Art Wilmarth will coordinate the discussion that follows. He is Professor Emeritus of Law at GW Law School, where he taught courses in banking law, contracts, corporations, professional responsibility, and American constitutional history. He is a prolific author, but I'm skipping detail on that for the moment. Hilary Allen is Professor of Law at Washington College of Law at American University. Her research focuses on the impact of new financial technologies on the stability of our financial system and also on potential regulatory responses to those technologies. She is a prolific author, but again, I'm skipping details for the moment. Amanda Fischer is the Policy Director and Chief Operating Officer for Better Markets. Better Markets is an organization that is an important voice on financial policy issues. Amanda has a deep expertise in financial regulation and public policy based on her work in government and policy organizations. Among other things, she was Chief of Staff and Senior Counselor to Gary Gensler, Chair of the Securities and Exchange Commission, prior to her joining Better Markets. I could take more time to provide further detail about our speakers' backgrounds, but I won't do that so that Amanda and Hilary and Art have more time to speak. And I welcome you all and express my appreciation for your being here. But Art, now I'll turn the discussion over to you.
Well, thank you very much, Don, and it's a pleasure to be part of this discussion this morning. And indeed, we're very honored and very fortunate to have Hilary and Amanda with us because they are 2 of the leading experts, and I would say 2 of the leading voices on financial regulation and financial reform issues in Washington, D.C. And so thank you very much to both of them. As Don said, we're looking at the impact of this recent executive order issued by President Trump, which certainly has the potential to open up a number of non-public investments for 401k plans and other defined contribution plans that obviously employees across the country have. So we're going to start with the potential impact on investments in crypto assets. And Hilary is going to lead us through that. And so I'm going to ask the following questions to Hilary and then let her address this topic. First, how does this executive order change the present state of the law? In other words, what restrictions have there been previously on the ability of 401k plans and other defined contribution plans to invest in crypto assets? And what do you think, Hilary, the potential impact of this change will be? And thinking of the advice that we would give to our audience who are indeed investors in such plans, what should investors do to prepare themselves for what looks like a very changed landscape for the types of assets that their plans might invest in?
Thanks, Art. So first of all, I'm going to say that this is not investment advice. This is my advice as sort of an observer of the industry. But the status quo prior to the Trump administration was a very cautious outlook from the Department of Labor with regards to the inclusion of crypto in 401k plans. And in fact, in 2022, there was guidance that was put out by the Department of Labor that urged 401k plans to exercise extreme caution in including anything related to crypto into any 401k plan. And what that really did was so 401k plans are fiduciaries. They are held to high standards of fiduciary duties. If they breach those by not taking care of their, the people who invest adequately, then they are open to litigation. And so when the Department of Labor put out, guidance that suggested that there should be extreme caution in including these crypto assets in 401k plans, that was essentially a signal to the various financial institutions administering 401k plans that they would likely be open to litigation if they were to include these. Now, that didn't preclude people from including them. Fidelity, for example, went ahead despite this guidance and said that it would be willing to include crypto in some of its 401k plans. The irony of that, although I can't 100% verify this, but what I was told was that Fidelity did not allow its own employees to have crypto in their 401k plans, but they were willing to offer it to others. And the reasoning for the Department of Labor in their 2022 guidance for discouraging these kinds of investments, they referred to things like the high volatility of crypto assets, the difficulty for novice investors to separate reality from hype when it came to crypto. They talked about the speculative nature of crypto investments. They didn't say the word Ponzi-like, but I will, because most crypto assets have nothing behind them and their value depends entirely upon the sentiment of people who might buy it from you. So that makes these assets highly speculative. It also creates significant challenges in valuing these crypto assets, because how could you possibly sort of figure out what future people are going to think of them? And the challenges of valuation was something else that was highlighted by the Department of Labor in their 2022 guidance. And I should note that valuation challenge is made worse or more complicated by just how manipulated the crypto markets are. There's lots of what we call wash trading, which is people trading back and forth between themselves, essentially to juice prices. So, for all of those reasons, there was this guidance, I think, that was very well thought out in 2022 that discouraged the inclusion of crypto in 401k plans. The Trump administration has repealed that guidance. And then we also have this executive order that is encouraging the investment of, or at least if not encouraging, nod, nod, wink, wink, saying we see no problem with you investing in these kinds of assets or including these kinds of assets in 401k plans. And so, that volatility, that speculative nature, these risks, the hype, none of that has gone away. What has changed is that it is now potentially going to be harder, although not impossible, to bring a lawsuit against a plan fiduciary who includes crypto in a 401k plan.
Well, thank you, Hilary. Do you see already 401k providers moving to sort of position themselves to offer these products? I mean, do we already see shifts in the industry happening to sort of take advantage of this opportunity?
So it's an interesting question, and I haven't been following closely the data on the individual providers. I think there is this sort of FOMO mentality right now infecting all parts of the financial markets, this fear of missing out. Although I saw someone talking the other day about the JOMO, the joy of missing out, which I would highly recommend in this space, that there will be a joy of missing out and some schadenfreude, I think, later in the piece if you skip these investments. But, when the narrative is so strong about how, crypto is the future and the administration is pumping it, I think there are probably plan fiduciaries. Well, I know for sure that there are some customers that are pushing their plan fiduciaries to include this kind of stuff because they're caught up in the narrative. And then I'm sure there are, plan fiduciaries. As I already mentioned, Fidelity has sort of long wanted to be in this space. And then I guess there are plan fiduciaries who are probably afraid maybe of countersuits of failing to include crypto in this, given the sort of the hype and the push behind crypto. So, I mean, I think this will definitely have changes on the industry. I'm not sure how they've shaken out just yet.
As a matter of history, we can remind the audience that crypto reached a similar peak, not as high as it is right now, but crypto got to about $3 trillion back in late 2021, and then did a swan dive and lost about 70% of market value by the time the end of 2022 rolled around. So, as you said, these are highly volatile assets that really move based on sentiment. Another thing I've noticed, I wonder what your thought is, that crypto seems to move very much in synchronization with the hot big seven tech stocks, but with even bigger peaks and bigger valleys. So if you were an investor and let's say you're already heavily exposed to the big seven tech stocks, does crypto offer you any apparent diversification benefits?
Yeah, no, that's a great question. I mean, as I said, crypto assets are Ponzi-like. They're entirely driven by narrative, and there's so many narratives to choose from, right? So there's the democratization narrative that is sometimes hyped. There's the innovation in the future narrative that is sometimes hyped. But there's also the hedge and diversification narrative that's sometimes hyped, that this is something that, when the stock market is doing zig, this'll zag, and that'll protect you. But in fact, what we see with crypto is that it is highly correlated. Price movements are highly correlated with stock price movements. So, the arguments that this is a hedge, they fall apart. The narratives, as I said, this is purely narrative driven speculation. The narratives move in the same direction, that same sort of optimism and tech futurism that we see that's about the AI stocks that is driving the stock market Magnificent Seven boom. That's the same narrative that we have about crypto, and those narratives will crumble together, in my view. I just wanted to add something more about the market cap that you spoke about. The numbers that are widely reported from the crypto winter in 2022 are indeed that the 3 trillion market cap fell to 1 trillion. But it's really hard to get a sense of what the real numbers are in crypto. I think those are actually grossly inflated numbers about the value of what's there. As I said, these are Ponzi-like assets. There's nothing behind them, and it's highly manipulated with all the wash trading. So you will hear these numbers cited, and these are the commonly reported numbers. But I just want to urge listeners to have sort of take any numbers you hear about crypto market capitalization with a huge grain of salt, given how much manipulation there is in the space.
Wonderful, Hilary. Well, thank you so much. We really appreciate that. And now we're going to move from crypto to the rest of the alternative asset universe, which includes a very broad variety of things like private equity funds, hedge funds, real estate investment trusts, other real estate vehicles, something relatively new called private credit funds. So these are essentially non-bank lenders, essentially who securitize their credit and offer it to investors. And again, I'm going to ask Amanda the same general questions I asked Hilary, which are, how would the executive order of August 7th change the existing landscape in terms of the ability of defined contribution plans to invest in these products, and what Amanda thinks the impact is going to be? And again, as Hilary said, we are not offering investment advice. We're only offering our own informed judgment about the potential risks and benefits of these investments. But what kinds of factors should investors consider before they agree that their retirement funds ought to be put into these alternative private assets?
Very similar to what my colleague Hilary said, it remains to be seen just how much these private assets will make their way into folks' 401k or defined contribution plans. The executive order certainly does try to encourage plan sponsors to offer these investment opportunities to employees. But again, they have a fiduciary obligation to their plan investors that they need to seriously consider before offering these investments. And generally speaking, the two main categories that the executive order seeks to expose 401k plans to are private equity and private credit. Private equity, just to level set, involves firms buying stakes in privately held companies with the goal of improving their operations, but oftentimes with a lot of financial engineering, and then being able to sell them at a higher value using investors' capital to fund it. And then private credit is direct lending to companies, but it's done outside of the banking system. And both of these sectors have traditionally been more lightly regulated than, say, mutual funds or the banking sector, based on the idea that the participants in the market are highly sophisticated individuals that don't need the protections in other financial products. So again, this is not investment advice, but plan sponsors would be well served to consider if these types of investments are appropriate for individuals that they're serving. Both private equity and private credit can be highly illiquid. They are not traded on a daily basis like mutual funds, so it can be difficult to get price discovery about just how much the assets are worth. Traditionally, small dollar investors have not been in this market. And it's really been a market where sophisticated individuals, sovereign wealth funds, endowments, and the like can do a lot of due diligence on the underlying investments in the companies and their financial soundness in order to make investment decisions. And that is obviously something that the average retail investor looking to invest their 401k is, they're just not equipped to do that.
I was interested, looking back in history, that by my reckoning, private equity has had, sort of three booms and crashes already. There was a big boom in the 1980s when private equity started out with Michael Milken, and then there was a huge crash between 89 and 92. There was another boom going into the late 90s, and then when the dot-com bubble burst in 2000, there was a big crash in 2000 to 2002, and there was another crash when the global financial crisis hit. They had been in a boom up until 2022 when interest rates started to rise. They benefited greatly from this extremely low interest rate environment between 2009 and 10 and 2021, because, as you say, their whole strategy is to borrow lots of money against the assets of the companies that they invest in. So it's a highly leveraged play. So the debt service costs are incredibly important in figuring out what kind of profits they can make. But as you say, that there's a lot of opacity. We don't know how good their performance actually is because they don't have to meet the normal 1934 Act public reporting requirements. But everyone seems to think the last 2-3 years have been not good at all for private equity. And the institutional investors, from what we can see, are turning away from private equity. So is it any surprise that they are turning toward retail investors and defined contribution plans now that their traditional investors are much less enthusiastic?
That's a great question. I certainly think that there is some there, and a lot of market observers are pointing out that this may be the industry's attempt to find exit liquidity or bag holders at a particularly turbulent time for the market. I will say that some private fund sponsors have been looking to get a hold of the $12 trillion in assets that sit in folks' 401k plans for a while. It just so happens that now is a really fortuitous moment. I believe that the private equity industry in particular thought that Donald Trump's inauguration was going to mean boom times for their industry, particularly since they expected a real pull away from merger scrutiny. They anticipated tax policy that would be very favorable. But to be honest, we're seeing that the market turbulence caused by tariffs and economic uncertainty and geopolitical tensions and, persistent inflation has really made the PE industry not boom as much as they perhaps thought they were. And some of the largest private equity funds in particular actually see their stocks down by, 8%, 20% year to date. So, the institutional clients that typically make up this market are less and less willing to make new investments. They're increasingly seeking to pull out of existing investments. Another factor at play is that endowments that have a lot of money in this space increasingly are looking to sell just because of the pressure on education funding right now. So as they look to raise money, they're looking to exit these investments. And we're seeing that the illiquid nature of the investments was perhaps masking some of the haircuts or inability to recoup your full investment that had been present but not revealed. So in the private credit market, for example, The CEOs of some asset managers are saying that they see deals trading as low as 50 cents on the dollar of what they thought it was worth. Another asset management firm at a conference earlier this year said to expect some accidents in the private credit industry. So again, I don't have a crystal ball, but it is very convenient that potentially this $12 trillion pot of money is opening up at this particularly volatile and turbulent time.
And the final question I would ask is, obviously, investors in defined contribution plans, as you say, most of them are not highly sophisticated investors, and they don't have access to the kind of information that professional institutional investors would have. So they're going to be really relying on the plan sponsors to present them with a menu of plans that are appropriate for their risk tolerance. So the question I would raise sort of at the end is, are plan sponsors really equipped to make the kind of detailed inquiries into individual private equity or private credit providers, what kind of portfolios they have, what kind of risks those portfolios have, what the underlying privately held companies look like? Are most plan sponsors equipped to do that?
In my estimation, probably not. And there's a good reason why they haven't entered this space quite yet. Again, nothing in law prohibited them from doing this before the Trump administration. Just to be clear, what the Trump administration has done is withdraw previous guidance that articulates the various cautions and considerations that plan sponsors should take. And essentially right now we have an executive order that's looking to cheerlead, but there's not a lot of legal heft behind it that should give plan sponsors comfort. I should say that a group of senators has written the Department of Labor asking them to explore legal safe harbors for plan sponsors that want to offer these assets. So there are certain members of Congress that are trying to put their thumb on the scale to insulate plan sponsors from liability associated with these offerings. Again, it's going to take a lot of time to sort out. And even still, I'm not sure that the Department of Labor can write rules that guard plan sponsors against their, intrinsic legal liability. But, folks should exercise caution when making 401k investments. Again, a lot of retail investors are already exposed to these plans if they have pension funds, and the record has been mixed. Private equity and private credit like to tout their higher returns. But when you adjust for fees and you adjust for some of the idiosyncrasies of how these funds, the timing of how they receive money, the adjusted returns, according to a lot of academic evidence, tend to be lower than just putting your money in the S&P 500. So I understand why the industry would be interested in getting access to this money because the fees tend to be higher. And again, it can be exit liquidity. But that doesn't necessarily mean much for the average retail investor. And I'll just close by saying this. When I was at the Securities and Exchange Commission in the last administration, we endeavored to write a rule, particularly related to private equity, that would have given investors a little more clarity and transparency over fund performance and would have put some disclosure guardrails in place for conflicts of interest. And the industry did not like that rule, and they took it to the Fifth Circuit, and the court vacated the rule on the grounds that the Dodd-Frank authority that the SEC used in the rule writing was really meant only to protect retail investors and not the big, sophisticated institutional investors that play in the private equity space. Now that the Trump administration is explicitly trying to get retail investors into this space, we do not have the protections that the SEC tried to put in place, but we do have increasing exposure potentially of retail folks. So I would also just caution that this space is not regulated like mutual funds. It is very hands-off attempts to provide more disclosures, things like annual audits, clear reporting of fees, expenses, and performance. They are not in place, and mileage can really vary between different fund providers. So just keeping all of this in mind and urging folks to exercise caution.
Many thanks, Amanda. That's extremely helpful. And many thanks also to Hilary for her insights and outlook on the crypto space. So certainly, I think the bottom line for all of us is that investors in defined contribution plans should keep aware of how their funds are being invested and should exercise great care and diligence before deciding to put large amounts of their funds into crypto or other alternative assets that aren't subject to the normal public reporting requirements and public oversight and disclosure requirements of major public companies. Don, I'll turn it back to you for closing comments. Thank you very much for making this possible.
Well, I want to thank all three of you for your valuable contributions here. I think this is going to be very valuable to our lawyers in the DC Bar because of the legal context you've explained. But I think your explanation of practical consequences will be very interesting and important to the wider audience we hope that we'll get. I apologize that we are time constrained, but I do think it's been very valuable. I thank all of you very much.